Deciding when to claim Social Security benefits is not a one-size-fits-all decision. Every retiree has their own special circumstances, and the consequences of making an uninformed decision can cost retirees, especially couples, hundreds of thousands of dollars over their lifetime. Today, we'll explain the basic Social Security terms and rules that affect the claiming decision, focus on some of the most misunderstood rules that make the claiming decision so complex, and show a case example that illustrates some of those rules. I'll also explain how I can help you make the most optimal claiming decision. The Social Security program is extremely complicated and confusing. Many retirees rely on Social Security for the majority of their retirement income. It is their largest asset. Although you may not realize it, when and how you claim your benefits is often the biggest financial retirement decision that you face. Social Security provides a number of benefits that address the risks associated with retirement. Your retirement benefits are like a defined benefit pension or an annuity payout upon quitting work that is paid for life and with cost of living adjustments. Survivor benefits are a form of life insurance if the breadwinner of the family dies, even at a young age, leaving a spouse and minor children. The Social Security disability insurance is not just for the elderly. The sobering fact for 20-year-olds is that more than 1 in 4 of them becomes disabled before reaching retirement age. And finally, Medicare is the largest payer of health care in the United States. This medical insurance does not cover 100% of all health care costs in retirement, but the monthly premiums cover a significant portion of hospital stays, doctor's services, and prescription drugs. As we all approach retirement age, a number of decisions are forced on us that can have very large and costly financial consequences if we're not well informed. The Social Security Administration has 2,728 rules, with exceptions to those rules, and therefore thousands of possible claiming strategies for each family. Studies show that 96% of retirees do not optimize this claiming decision. They are simply not well informed and are therefore leaving money on the table. This is because there are few reliable resources. SSA is not allowed to give personal claiming advice. There's a tremendous amount of misinformation and actually false information in the press, and we don't know who to turn to for help. The average 2023 Social Security benefit is $1,827 per month, or about $22,000 a year. Now, this may seem like a lot to some people and not much to others, but Social Security is not meant to replace 100% of earnings. It replaces approximately 40% of a low wage earner's income and less than 10% for high wage earners. But $22,000 amounts to $550,000 for a retiree who lives 25 years in retirement, and some couples can receive as much as $2 million. This is a significant asset. A majority of retirees, even though this income is their largest asset, simply claim as early as possible at age 62, while not understanding the long-term consequences of that decision. This is a screenshot of our RSSA roadmap software showing the lifetime amounts Alice and Peter will collect if they file at various ages. They have a 12-year age difference. You can see that the lifetime differences between collecting at ages 63 for Alice and 70 for Peter, that gives them the maximum lifetime amount of $1.585 million, is an increase of more than $375,000 compared to the lowest amount in the lower left-hand corner of $1.208 million. We are looking at the two extremes, but the importance of the analysis is that individuals are able to see all the options and choose the one that fits their financial situation. It's rarely the maximized lifetime or the lowest amount, but somewhere in between. These types of analyses are possible with the predictive planning tool of powerful software that is capable of examining relationship status, single, couple, divorced, or widowed, relative ages and earnings for couples and divorced individuals, maximum anticipated life expectancy, dependents, such as spouse, minor children, and disabled dependents, pensions, and how long you're planning to work, and many other personal details. Let's talk about full retirement age, FRA. Full retirement age is the age at which we receive what is known as the full unreduced benefit, and that is called the primary insurance amount, or PIA. Full retirement age is based on the year that we're born. You can see those born 1943 through 54 had a full retirement age of 66. From 1955 through 1959, that full retirement age increases by 2 months per year, and those born in 1960 or later have a full retirement age of 67. Full retirement age is also the age at which we are no longer subject to the earnings test limits, and we will be talking about that in a few slides. Also, that is the time when retroactive benefits can be paid. If someone collected at a certain age after full retirement age and wish that they had collected prior to that, they are able to request those retroactive benefits for up to 6 months. You can also see on the slide that if someone's birthday is the first of the month, they are assumed to be born in the prior month. And therefore, for those born January 1st, they are assumed to be born in the previous year. To be eligible to collect benefits, individuals must have worked and paid Social Security taxes on earned income for a minimum of 40 credits or quarters of coverage. Only 4 quarters or credits can be earned each year, therefore it takes 10 or more years to become eligible. The current 2023 value of 1 quarter credit is $1,640. Therefore, once you have earned $6,560, you've earned those 4 credits for the year. As employees, we and our employers all pay Federal Insurance Contributions Act, FICA, payroll tax contributions on earned income up to what is known as the annual maximum taxable earnings amount. That is currently $160,200 for 2023. The amount contributed is 6.2% into Social Security and 1.45% into Medicare, for a total of 7.65% for the employee and the employer. The total paid for employee and employer is therefore 15.3% of earned income. Once we are eligible to collect Social Security benefits, the highest 35 years of indexed earnings, including zeros if there are years with no earnings, are then added up and divided by the total months in 35 years, 420. This is what is called the average indexed monthly earnings, or AIME. AIME is then separated into 3 portions by what are known as the 2 bend points. From there we calculate PIA. PIA is the sum of 3 different percentages of those portions of AIME, and in this case you can see that the individual will receive $2,990 per month at their full retirement age. Since PIA changes over time with future earnings, estimates are much more exact the closer we are to our full retirement age. Even if someone is working after they start collecting benefits, those years may be recalculated in the top 35 and the PIA may increase. This chart details the reductions and credits for those with a full retirement age of 67. By choosing to collect Social Security early, the monthly benefit will be reduced by a fraction of a percent every month prior to that full retirement age, and you can see that will equal 70% of the PIA at age 62. If individuals are able to delay collecting benefits, retirees will accrue delayed retirement credits, again, each month, totaling 8% per year, which results in a 24% increase above the PIA at age 70. This is with a PIA of age 67. Remember, this is a monthly decrease or increase, so every month that we delay, our benefit amount increases by a fraction of a percent. If this individual collected at 62, she would receive $2,093 per month for life with cost of living adjustments. But if she's able to wait to collect for any month or year after that up to age 70, that would increase. And you can see at age 70, the amount would be $3,708. This is an increase of approximately 77% above the age 62 amount. And as I mentioned, these do not yet include cost of living adjustments for that inflation that are applied to benefits each January after the age of 62. This slide shows a screenshot of our RSSA roadmap software showing the benefits that will be collected at different ages. For this individual, the full retirement age is exactly 67. Therefore, you can see that that is when they collect 100% of their PIA, and that amount is $3,708. For those born in 1955 through 59, full retirement age will vary from 66 and 2 months up to 66 and 10 months. So with this PIA of $3,708, the individual would collect $2,611 at age 62 and $4,598 if they wait to claim until age 70. Let's talk about maximum life expectancy, and that is maximum, not average. We want to avoid the danger of underestimating our life expectancy and outliving our funds, also known as longevity risk. There are a number of risks in retirement, and running out of money is one of the top worries for retirees. Other worries include rising healthcare costs, inflation, and of course, market risk. This graph shows life expectancy probabilities at age 65 for women, men, and couples. For instance, a 65-year-old woman has a 71% chance of living to age 80 and a 31% chance of living to age 90. The 65-year-old man has a 60% chance of living to 80 and a 20% chance of living to 90. But for couples, at least one individual has an 88% chance of living to 80 and a 45% chance of living to 90. So this is important to keep in mind when discussing Social Security survivor benefits due to the way that those are calculated on the higher earners PIA, and we'll get to this soon. A spousal benefit is a benefit that one spouse receives based on the other spouse's earnings record. The other spouse must be collecting their own retirement or disability benefit for a spousal benefit to be paid. And the maximum spousal benefit is 50% of the other's PIA if collected at full retirement age. As you can see on the slide, that amount decreases if collected earlier than full retirement age. When applying for benefits, if entitled to both your own retirement benefit and a spousal benefit, only the higher amount of the two will be paid. The requirements for married couples are that they must have been married at least 1 year, and for ex-spousal benefits, they're very similar, but the couple must have been married for 10 or more years, and the recipient must be currently single. To determine ex-spousal benefit amounts, contact the Social Security Administration to request your ex's PIA. You will need to provide their birth date, place of birth, and the details needed to show that your marriage lasted for 10 or more years to get this information. This is a screenshot from the RSSA Roadmap software illustrating how spousal benefits increase up to full retirement age when they reach 50% of the other spouse's PIA. In this case, you can see at full retirement, age, the spousal benefit is $1,854. Therefore, the other spouse's PIA is $3,708. Survivor benefits are paid when one spouse has died. They are often confused with spousal benefits when both spouses are living. Survivor benefits are a topic that couples should consider carefully since the surviving spouse will inherit the larger of a couple's benefits with a few conditions. Widows or widowers can begin collecting survivor benefits as early as age 60, but at a reduced amount, as you can see on the slide. Each year that a surviving spouse waits to collect, the survivor benefit amount increases up to full retirement age when it is 100% of the deceased's benefit. Also, if eligible for their own retirement benefit and a survivor benefit, one may be collected first, even if it is a smaller amount, and the other later when it has become as large as possible. Disabled widow and widowers can begin collecting survivor benefits as early as 50, but again at a reduced percentage. There is a special rule called the widow's limit, and it is in place to protect survivors whose spouse collected their benefit early. The rule allows the survivor to collect either their spouse's benefit or 82.5% of their spouse's PIA, whichever is higher. For an individual who is with a full retirement age of 67, if the deceased spouse had started collecting at 62, they were only receiving 70% of their PIA. So this widow's limit is a helpful increase for widows or widowers in this situation. Besides spouses, other dependents are also eligible for up to 50% of the PIA of the parent collecting a retirement or disability benefit. Or if a parent is deceased, they are eligible for up to 75% of what the deceased was collecting, or eligible to collect at the time of their death. Also, only a family maximum benefit amount is allowed when there are multiple dependents that are collecting based on one worker's PIA. The family maximum benefit is between 150 and 180% of the worker's PIA. If both parents are collecting, a combined family maximum benefit is calculated. Other eligible dependents include an unmarried child under the age of 18 or 19 if still in high school. This can also include a stepchild, grandchild, step-grandchild, or adopted child. A child of any age if they were disabled before age 22 and unmarried. The caregiving spouse of a minor child who is under the age of 16, and even the parents of the deceased if they were dependent on the child for the majority of their income. There are other factors to consider when claiming Social Security. First of all, future anticipated earnings can have a large impact on a worker's PIA, and the Social Security Administration is assuming that workers will continue to make their current income for the remaining years until they begin collecting. With software, this can be calculated, since retiring does not always equal collecting retirement benefits for everyone. Disability benefits, SSDI, awarded prior to full retirement age will convert to retirement benefits. SSDI benefits are based on an individual's PIA at the time determination of those disability benefits is made. Therefore, they become retirement benefits and are then paid from a different trust fund at full retirement age. Some individuals are divorced, widowed, or even married multiple times, each for over 10 years, entitling them to the highest of the various spousal or survivor benefits. They have the ability to choose the highest spousal and/or survivor benefit in these cases. At full retirement age and later, individuals filing for benefits are eligible to request retroactive benefits for up to a maximum of 6 months paid in a lump sum. This can be done if an individual wishes that they had started collecting earlier and that means that they can receive this lump sum. This may seem like a windfall, but they are then losing the delayed retirement credits earned for those 6 months, and therefore it permanently reduces the payment by 0.2% per month, which is 4% for a 6-month retroactive payment. Once you have determined what rules apply to your circumstances, understanding the details about those rules will give you the power to avoid making claiming mistakes. The earnings test is one of the most common rules that surprises retirees. It applies if an individual is collecting retirement or disability benefits while still working and younger than full retirement age. There are 2 thresholds. The first threshold applies to those who are 62 up to the end of the year before full retirement age. This limit in 2023 is $21,240, and $1 for every $2 earned above this amount will be withheld from future Social Security payments. The same is true for those months and part of the year up to the month of full retirement age, but this is a larger threshold of $56,520 for 2023. And in this case, only $1 for every $3 earned above this limit is withheld from future payments. Upon reaching the month of full retirement age, the earnings limits no longer apply. The rule only applies to earned income, as shown on the slide. The major pitfall of this rule is the danger of a Social Security Administration overpayment. This occurs when an individual is receiving full benefits while earning over the limit. It also occurs with non-covered pensions, returning to work, or income increases. So the best advice is to be very proactive. Let the Social Security Administration know that you are earning more than these limits prior to them withholding them from your future Social Security checks. Those collecting dependent benefits may also be subject to the earnings test if they are younger than full retirement age and still working. Contributions to Social Security are made by employees through the Federal Insurance Contributions Act by way of payroll taxes. Employers match the amount paid. Some employers do not withhold payroll taxes and instead offer their employees pensions. These are known as non-covered pensions, and they are from jobs where those FICA tax contributions were not paid by the employee or the employer. They are generally from federal, state, or local government jobs. Covered pensions are from jobs that did pay into Social Security, generally private or public companies, and they do not affect Social Security benefits. The 2 non-covered pension rules are the WEP, Windfall Elimination Provision, and the GPO, or Government Pension Offset. WEP applies when someone is collecting both a non-covered pension and their own Social Security retirement or disability benefit. The WEP rule modifies the calculation of the worker's PIA, and the reductions and credits are applied to that adjusted PIA. It can also reduce benefits for dependents of that worker. The WEP cannot zero out the retirement benefit, though, or reduce it by more than half the pension amount. The current maximum reduction for WEP in 2023 is $558. The government pension offset, on the other hand, applies if an individual is collecting a non-covered pension and also a Social Security dependent benefit, such as spousal or survivor. The GPO reduces the dependent spousal or survivor benefit by 2/3 of the pension amount, and if the pension is taken as a lump sum, GPO will be calculated as if it is paid monthly. The important thing to know with GPO is that it can reduce the benefit to zero. There are exceptions, pensions, for instance, that are not based on your own earnings, or if you paid into those FICA taxes for the last 60 months of employment. Now, it's not really the pension, but the agency that is paying the pension and or also having their employees contribute to Social Security. It's the employer's ability and choice to offer both. I want to close with a case example for a couple, Paul and Alice. Now, Paul and Alice, as you can see, are both 62 and they have full retirement ages of 67. They also have the same maximum life expectancy of 85. So the question for them is, can they afford to wait to claim? We're going to take a look at them claiming at 62 and at full retirement age, and then at their maximized strategy. So what should they do? First of all, if they both claim at 62, Paul will receive that reduced amount of his PIA from $3,000 down to $2,100, and Alice would at the time claim a spousal benefit, a reduced one, but that would be $975, and that's larger than her own reduced retirement benefit. So the couple would receive, if they both started at 62, $3,075 per month. If they wait until full retirement age, Paul would claim that full PIA of $3,000. Alice would claim the full spousal amount, which is 50% of that, $1,500, and their total monthly benefit at 67 would be $4,500. And on this slide, we see the maximized filing strategy for Paul and Alice. Paul would claim his retirement benefits at 70. That would maximize his amount up to $3,720. It would also give the couple the largest survivor benefit. At that time, Alice would be eligible for spousal benefits as well, but still the maximum amount would be $1,500. Their total monthly benefit from age 70 on would then be $5,220. What Alice can do, however, prior to age 70 is claim her own retirement benefit of $1,000 a month. Because Paul has not claimed his own retirement benefits, she is not yet eligible for a spousal benefit. Then once he claims at 70, Alice would get that spousal bump up of $500 to bring her up to the $1,500 full spousal amount. I'm happy to provide a no obligation initial consultation if you'd like to meet with me, and this gives you the chance to ask questions, and I can provide you with insight into some of the Social Security rules that may affect you. As an RSSA, I've been educated on detailed Social Security rules and trained to analyze and explain your claiming age choices. Our Social Security Roadmap software includes all possible Social Security rules. If you'd like to proceed with an analysis, I can give you access to the software so you can enter your initial information if you'd like. Given that our Social Security benefit amounts change every month from age 62 to 70, there are thousands of possible claiming age possibilities. The software generates an extensive 20-page PDF report, including lifetime, annual, and monthly benefit amounts, comparison graphs and tables, instructions on filing, and rule explanations. I'll walk you through the results and the various claiming options so you're completely comfortable with your ultimate decision. Seeing the actual dollar amounts makes it much easier for you to make that optimal claiming decision. In conclusion, Social Security is a significant and large asset, much more money than many people realize. You should take particular care when deciding how and when to claim your Social Security benefits. This decision, though, should not be done in a vacuum. When integrated with your complete financial information, including other income, expenses, assets, retirement accounts, taxes, and legacy planning, the choice of making an optimized Social Security decision can have the effect of extending the life of your portfolio and increasing your standard of living in retirement. I hope you've gained some valuable insights into the importance of Social Security and really understanding your options before you file to collect benefits. I will take any questions you have now. It has been a pleasure presenting for you today. Thank you so much, and always feel free to reach out to me with your questions and comments.